Most people think stocks run the financial world. They don't. Bonds do. Warren Buffett doesn't start by asking if a stock is cheap. He starts somewhere else entirely. He'll ask himself, can this investment beat a U.S. government bond? That one question controls every investment decision he makes. Here's why that matters to you, even if you've never bought a bond. The global bond market, worth over $145 trillion, quietly controls your mortgage rate, your credit card interest, and whether your retirement account grows or stalls. Buffett understands something that most investors miss. Bond yields are the measuring stick of every investment decision. Stocks, real estate, businesses, everything. Think of bonds like a ruler. You don't build a house with a ruler, but without one, you can't tell if anything is straight, if materials fit, or if you're getting ripped off. Bonds are the financial world's measuring stick. It's why professional investors obsess over them and casual investors ignore them. If you don't understand bonds, you're investing blind, even if you think you're being conservative. So what exactly is a bond? Here's the simplest explanation. A bond is an IOU. That's it. When you buy a bond, you're lending money to someone. Could be a company, could be the government, and they're promising to pay you back with interest. Let's say you buy a $1,000 bond from the U.S. government with a 5% interest rate that matures in 10 years. Here's what happens. You give the government $1,000 today. Each year, the government pays you $50 in interest. That's 5%. If you still own the bond, after 10 years, the government gives you your original $1,000 back. You're the investor, they're the borrower. The bond is just a contract. So bonds are different from stocks. With a bond, you don't own anything. You're just getting paid to loan out your money. With a stock, you actually own a piece of the company. This is where it gets interesting and where most people get confused. Bond prices and bond yields move in opposite directions. When bond prices go up, yields go down. When bond prices go down, yields go up. This may sound weird at first, but once you understand it, everything about the financial market starts making sense. Let me show you exactly how this works. Let's say you buy that $1,000 bond paying 5% interest, so you get $50 a year. That's your yield, the return you're getting at the price you paid. Now, let's say interest rates in the economy go up to 7%. The government starts issuing new bonds that pay $70 a year instead of $50 a year. Here's the problem. You're stuck with a bond that only pays $50. If you want to sell it, nobody's going to pay you $1,000 for it. Why would they? For the same price, they can buy a brand new bond that pays $70. So what happens? The price of your bond drops. On a 10-year bond like this, that rate increase can easily knock 20 to 30% off the price. Suddenly, your $1,000 bond is only worth $700. Now let's flip it. Say interest rates in the economy drop to 3%. New bonds are only paying $30 a year. Your bond paying $50 a year suddenly looks amazing. Everyone wants it. People will pay more than $1,000 to buy it from you. Maybe they'll pay $1,200 or $1,300 for it. So why should you care about this? Because the inverse relationship between bond prices and yields is absolutely critical to understanding how money works. When bond yields or interest rates change, everything in the financial system changes with it. The global bond market is larger than all publicly traded companies combined. It's bigger than the entire stock market. Governments use bonds to fund everything from roads to wars. Companies use bonds to expand, to buy equipment, to survive downturns. Bond prices and yields tell us what's happening in the economy before almost everything else. When the Fed fears inflation is too high, they'll raise rates. If it believes we're headed towards a recession, they'll lower rates. The bond market is basically the economy's vital signs monitor. This is huge, so pay attention.
is a big one.
When Buffett looks at any investment, he's always asking himself one question: can this beat what I get from a risk-free Treasury bond? Now you may be asking, why are Treasury bonds considered risk-free? Because stable governments like the US can meet their debt obligations by printing money and or raising taxes. And if they can't do either one of those things, we'll have much bigger problems than our bond portfolios. So Buffett thinks like this: if I can get 5% from a risk-free US Treasury bond, then any riskier investment must offer more than 5% to be worth it. A stock? It needs to return 7%, 10%, maybe even 15% to justify the extra risk. The same goes for a rental property or a private business. This is the framework. So let's look at the fundamentals. Bonds are IOUs. When you buy one, you're the lender. Bond prices and yields move in opposite directions. And Treasury yields set the baseline return every other investment must meet. If you understand these three things, you already know more about money than most investors ever will. But here's where it gets really interesting. Now that you understand how bonds work, the next question is, should I actually invest in them? Buffett has some really surprising opinions about this. In certain environments, he's called bonds dangerous and warned they can be even riskier than stocks. And yet, his company owns $360 billion worth of Treasury bills right now. So what's going on? In part 2, I'll show you exactly why Buffett overwhelmingly prefers stocks, when bonds become a trap, and when and why he actually buys them. If you want to avoid the biggest mistake people make with safe investments, you won't want to miss it. Part 2 will drop soon. I'll see you then. Thanks for watching.